Okay, thanks everyone for joining our AWSN session. Today we'll be presenting Stefanie Luhrs, who will be showing us the decrypting cyber insurance and what you need to know. Just a few rules that we just need to go through first. The session will be recorded, and essentially these are our code of conducts here. And obviously, if there's any unacceptable behaviours, they will be reported. Housekeeping and Zoom etiquette. Please make sure that you raise your chats through the chat messaging icon there, and also just be on mute as well. Some upcoming webinars. So we've got one on the 20th of August with Louisa Schneller, another one on the 17th of September with Michael Redmond, and then we're just lining the next one up with Cyber CX in September. A few mediums to keep in touch with ourselves through LinkedIn, Twitter. Obviously, we have our recordings here and also on YouTube. And I'd like to say thank you to our sponsors, Women in Cyber, Cyber CX, ASD, CISO Lens, AGL, and Off Cyber. Please confirm your AWSN membership. The link that is there, and I understand that will also be appearing on the chat very shortly. And just be mindful that when connecting to AWSN through some work networks, that may be blocked, so just do that through your personal computers. And on that note, I shall hand over to Stefanie, who will present the webinar to you. Thanks very much.
Okay, thanks very much. Can you see my slides currently? Yep, I think so.
Yeah.
Thank you everyone for tuning in. I know that this topic can be met with a little bit of skepticism and sometimes a few yawns. So my aim today is to keep you engaged, but I really want to arm you with some information about how cyber insurance is currently operating in the market, and to give you some ideas about the types of questions that you can ask your insurer, and perhaps even debunk some of the misconceptions about cyber insurance that are floating around. It's certainly not a sales pitch. I'm not employed by an insurer. I'm actually a lawyer, which might make things better or worse from your perspective. I'll let you be the judge of that. But jokes aside, it's a real pleasure to speak to you about this. I know it can be a dry one, so I will do my best to keep things light. To give you some very quick insight into my experience and why I feel I can talk to you about cyber insurance, I've acted as both coverage counsel and privacy counsel, as well as incident response manager in a variety of cyber claims, usually where coverage has been extended to an insured organisation under a standalone policy. So I'm able to give you some insight about what happens from the front line when an insurer is involved. And so with that in mind, I'll be drawing on a number of real life examples that I've dealt with, as well as some more publicly known incidents throughout my presentation. Before I delve in, I'll very briefly outline what it is that I propose to run through. Firstly, I'll tell you a little bit more about my role as a lawyer in cyber and the streams of work that an insurer would usually involve me in after coverage has been extended to you. I'll take you through the Australian regulatory landscape to give you some context to our discussion. Then I'll take a quick look at the state of the Australian cyber insurance market and some common misconceptions about cyber policies. I'll chat to you about cyber risk management and some common ways you can integrate that into your existing risk management strategies. We'll work through some of the key components under a typical cyber policy, including your first party and third party cover, as well as some common exclusions and tensions. We'll look at what to expect when making a claim under your policy and what can go wrong. And then finally, I'll give you some tips for how to ensure that you get the most out of your policy and that it responds effectively if you're hit with an attack. So as I mentioned, you can see from this slide that a legal role in cyber has various arms. So this gives you a quick snapshot of the type of work that usually falls within my remit and at what stage. cyber insurance usually applies to most streams of this work, except for pre-incident work that might include things like privacy policy reviews or data mapping. But when a cyber policy is triggered, you'll see that there are a number of points in time in which a lawyer might be engaged by an insurer. So that includes as coverage counsel, incident response manager, and privacy counsel. As to coverage counsel, insurers will sometimes engage panel lawyers to determine whether a policy responds and what losses are covered, rather than performing that in-house. Insurers will also engage lawyers to perform the role of incident response manager, which basically involves managing and coordinating the insurer's third-party panel vendors like forensic IT experts, notification and call centre vendors, and even PR teams that might be engaged by an insured organisation under a cyber policy. The benefit of having a lawyer perform this role is that the incident response coordination is protected by legal professional privilege, so it may potentially help to avoid the disclosure of any sensitive information about the investigation later in time. My role will also extend to acting as privacy counsel, which really comprises a number of different parts, but the first is the notification advice that we provide, where an insured needs to consider its reporting obligations and any notifications that made to regulators or affected individuals after a breach. And that might also extend to informing you about whether the incident gives rise to any non-compliances under the Privacy Act or any other legislation that might be applicable to the industry in which you're operating. It might also include drafting notification statements and coordinating the notification to the affected individuals. Privacy counsel usually also assists you in preparing for and responding to any regulatory investigations that might be commenced by a regulator after they're notified of an incident, and it can even extend to defending third-party claims or complaints that might be made by affected individuals whose information has been compromised. And finally, insurers' favourite topic, recovery. So if the losses incurred by the insurer in responding to the incident are significant, then it might consider its prospects of pursuing a recovery against the malicious third party or any other parties that ought to have prevented the breach. That can kind of be quite challenging because the principal party that's usually responsible is usually located overseas or isn't traceable. So we often need to consider recovery against other parties that either suffer the breach or ought to have known about any suspicious activity or vulnerabilities in their systems before the breach occurred. So just quickly, as to the regulatory landscape, the Office of the Australian Information Commissioner is the primary regulatory body, though there are others including APRA and ASIC that now act as secondary regulators. The OIC is the the primary regulatory body, and they're responsible for regulating compliance with the Privacy Act and the Notifiable Data Breaches Scheme that requires organisations to notify and affected individuals about what's known as eligible data breaches. The OIC will regularly release statistics about the incidents that have been reported to it, and you'll see here that for the first 6 months of this year, 518 breaches were notified under the scheme, which was down slightly from the prior 6 months. Malicious or criminal attacks were the leading cause of data breaches, and breaches arising from human error were up slightly to 34%. But contact information continues to be the most common type of personal information involved in a breach, and that includes things like your name and email address, physical address and phone number, for example. The health industry consistently has the highest number of notifications, and that really isn't a surprise. I think most of you will know that your healthcare data is like a treasure chest of information about you, and it probably contains enough for threat actors to set up bank accounts in your name or even credit cards. Keep in mind the penalties that apply for non-compliance with the Privacy Act. So the upper limit is currently $2.1 million, but the government's also announced its intention to increase those penalties to $10 million or 3 times the value of any benefit obtained through the use of that information, or 10% of a company's annual domestic turnover, so whichever is the greatest. Those changes will, the proposed changes will also provide the OIC with some powers to issue new infringement notices that come with penalties of up to $63,000 for companies, and up to $12,600 for individuals who fail to take steps to resolve minor breaches. We haven't yet seen any penalties for failing to comply with the notifiable data breaches regime just yet, but I think the tide is turning and we can expect to see the Commissioner take a harder stance in the coming months and certainly the next 6 months, I would think. Now moving to the insurance landscape in Australia. So the market here is relatively immature when you compare it to places like the US. Globally, the US cyber insurance market is by far the most developed, and it represents around 90% of the global insurance market, a cyber insurance market rather. But take-up in Australia is increasing as there's now some growing awareness of it through high-profile incidents like the breach that affected Landmark White last year, which was a big valuation company, as well as the ransomware incidents affecting Toll earlier this year. We're also seeing a number of new entrants entering the market who are providing some new coverages, but they're also helping to stabilise premiums. But because of the market immaturity, you do see some variances in premium for the same risk. I think that a lot of people are still coming to grips with the policies, and there needs to be some better education around it, generally speaking. I think there's certainly a lack of knowledge about the type of cover that a cyber policy will typically provide and how the vendor panel arrangements are supposed to work once there's an incident. The most active area for disputes relating to cyber claims tends to arise from a concept known as silent cyber, and that occurs where claims for cyber incidents are made under traditional policies like a professional indemnity policy or a property policy, and not a standalone cyber policy. So these are policies that were never designed with cyber exposure in mind, and they were likely designed before cyber became so significant. So insurers are now reviewing their traditional policies, and they're looking to tighten the policy wording to either affirm or exclude cyber risks. Lloyd's, which is the epicenter of the insurance world, has issued a mandate that requires insurers to expressly affirm or exclude cyber related for all property policies that were issued after the 1st of January this year, and the other policies will follow that as well. Most insurers are reporting a high frequency of ransomware events, and there is anecdotal evidence of higher than usual sums being demanded from organisations. We're also seeing a number of ransomware incidents where threat actors have had unauthorised access to the organisation's systems for months in preparation for executing the ransomware, and during that period have exfiltrated data, giving rise to a data breach. So that really increases the insurer's costs of responding to the incident, because as well as trying to deal with a ransomware event, you also need a forensics team to look closely at the path of the threat actor to determine what files have been opened or accessed or even exfiltrated prior to the ransomware being deployed. So you need to understand those things so you know whether the incident gives rise to any additional notification requirements to regulators or affected individuals. So how does cyber insurance fit within your overall cyber risk framework? I think that an effective risk management strategy will likely have several parts that interlink. Some of these are listed on the slide, but at the very least, an effective strategy will have good IT systems and controls in place, an employee awareness program, and an incident response plan. Cyber insurance isn't a substitute for investing in your security or your IT, but it is a good risk transfer strategy, and it can enhance your existing cyber risk systems by building synergies within your overall framework. So let me work through that a little more. I think that it can promote awareness within the organisation about its exposure to cyber losses. And I say this because insurers have good visibility over what's happening in the market when it comes to claims data, and they want you to mitigate your risk. They will share their knowledge with you about that, and they'll work with you closely to help you reduce your risk. Organisations often also find that during the underwriting process, so that's the process of obtaining a policy, that they're alerted to weaknesses in their existing controls. And that's because insurers tend to ask a range of questions about your information security systems and controls. They might look at things like the amount and type of data that you have stored and the security measures that you have in place. They'll also look at where it's held and any third-party vendors that you engage, They might look at your cyber awareness training, and they'll also want to know about any prior data breaches, of course. But this process can kind of act as a self-assessment or a self-reflection tool and help to iron out any wrinkles in your existing strategy that might come to light during the underwriting process. It can also act as a means of transferring a portion of your financial exposure to the insurer. So that's particularly important when you think about your business's likely financial losses if it's to shut down for a week or two, or even a month in some cases. So business interruption losses of that kind would be covered under a policy. It's not the initial upfront costs of dealing with an incident that's going to cripple your business, but it's the business interruption loss, so your lost revenue during that period, that can really do some damage. And good risk management pays off. So insurers may provide incentives for risk reduction, so things like lower premiums or excesses. So having a comprehensive risk management framework in place will help you with those types of things. The more controls you have and risk management strategies you can demonstrate to your insurer, the better place you'll be when you speak to them about getting a policy. On the other hand, if you overinvest in your cyber insurance and you underinvest in your security controls, then your premiums are probably going to be higher, because an insurer will have to make some assumptions about your controls and your risk management framework. So they'll charge you a premium for that, or they'll offer you only limited coverage, or perhaps even none at all because the risk is too great. So with all that in mind, I think that the best approach for organisations is to pursue a proactive cyber risk management strategy that's properly balanced with cyber insurance. And remember that the other risk management components you can see on the slide, they're important for improving your prospects of getting a comprehensive policy that has the right cover and at a good price. So let's talk about some common misconceptions about cyber policies that we regularly hear. The first is a common one, that insurers don't pay and they seek to avoid cover. Look, there's very little publicly available data about the amounts paid out under cyber policies in Australia, but there have been plenty of successful claims on cyber insurance policies, and my involvement in a claim is usually where coverage is extended to the insured organisation under a policy. So I can talk to the types of costs that I see paid out by insurers, and the initial upfront costs usually that usually are covered. Things like forensic and legal costs, they can be significant. So even small businesses can spend in excess of 50 grand just responding to an incident. And that's only the cost of understanding what's happened and obtaining some legal advice about your regulatory and privacy obligations. I've seen some ransomware incidents where the costs of paying the ransom demand, as well as the subsequent forensic costs of investigating whether any data was exfiltrated, have exceeded 80 grand as well. So the reality is that insurers do pay, and sometimes the costs are significant. Which brings me to the next misconception, that cyber isn't fit for purpose. I think that this misconception is interlinked with the first assumption that insurers don't pay. And when people argue that cyber isn't fit for purpose, I think it's usually in circumstances where an insurer has declined a claim, and to the insured surprise, it doesn't have cover for that particular type of loss. So this usually occurs in circumstances where the organisation hasn't really conducted enough due diligence prior to purchasing the policy and just doesn't understand the levels of cover that it's entitled to under its policy. So you really need to work closely with a specialist cyber insurance broker to ensure that the key risk areas that are applicable to your business are covered prior to purchasing the policy. Depending on the type of business in which you're operating, you may not need certain types of cover, or you may need extras. So you need to be aware of what the key risk areas are, work closely with your broker so you know what is and what isn't covered before you have an incident, and run through scenarios with your insurer and your broker. I hear a lot of businesses argue that, look, we're a small business, we don't need it, we're not a target. But I think the reality is that threat actors are increasingly targeting small businesses, as their data security tends to be less advanced than your bigger corporates. And look, it's usually the most vulnerable that are affected the most. Last year, a study by the Australian Cybersecurity Centre found that 62% of businesses had reported that they'd previously been a victim of a cybersecurity incident. And IBM's just released a report suggesting that the average total cost of a data breach to an Australian business for the 2020 financial year was $3.35 million. Another thing we often hear is that investing in IT infrastructure eliminates the need for insurance. If you invest heavily in IT security, then yes, you may be less vulnerable to certain types of cyber attacks, and you won't be able to eliminate human error though entirely. So even large corporations that spend big money on IT security every year, they still get hit, and you'll always run the risk of having a laptop misplaced, or even having your employees inadvertently click on a link or send personal information outside the organization. And remember that data breaches resulting from human error, they accounted for 34% of all breaches reported to the OISC in the first 6 months of this year alone. So keep in mind that your people are probably going to be your weakest link in your IT security process. Employee awareness programs might help to reduce the likelihood of accidentally clicking on a malicious link or being tricked into transferring funds to a fraudulent account, but it's not going to eliminate those risks completely. Finally, I often hear that we don't need cyber insurance because we don't hold any sensitive data. Cyber insurance covers more than just losses arising from data breaches. It'll extend to things like business interruption, network interruption, and ransomware events as well. And remember that things like customer information, financial and accounting data, and tax file information, that can all be targeted. And that stuff is held by most businesses, so it can give rise to an eligible data breach that requires notifications to regulators as well. Business interruption is also a huge cost to organisations. As I mentioned before, that will account for your lost business profits during the period in which you're responding to an incident when your systems are down. And fraudulent funds transfers because of social engineering will also sometimes be covered by cyber policies. And most businesses that send money by transfer is susceptible to that type of attack despite not having any sensitive data. Ransomware incidents, they can also cripple organisations. Take Toll, for example, earlier this year in the logistics industry. It took them several weeks to recover from the first incident, and then they were hit with the second. And I read recently that the Japanese parent company is now looking to sell its Australian arm of the business. So these types of attacks don't always involve the theft of data, but they can still have some severe consequences, even for big corporates. So your typical standalone cyber policy will usually have 4 key components or key insuring clauses. The different clauses will be engaged as the incident develops and more information becomes known. And I'll work through these in some greater detail, but to quickly outline, the first is access to a 24/7 incident response hotline that you can call when you have an incident. You'll have immediate access to the insurer's expert panel vendors, which would include a forensic IT expert, a law firm, or even a PR team if you need it at that point. The second component is cover for your first party losses. So this is a key insuring clause, and it pretty much covers your costs of getting the business back to normal. It will include the cost of the vendors you might need assistance from when you call the hotline, as well as things like data restoration and ransom demands as well. Next is your third party cover. That covers claims for compensation by third parties and can extend to things like fines or penalties as well that are issued by a regulator. And finally, you have cover for business interruption losses, which, as I mentioned, will reflect your lost profits for the period in which your business is down. So let's talk about the 24-hour hotline. Most incident response teams have 24/7 hotlines or an email address that an insured can contact in the event of a breach. I find that most incidents are usually notified via a hotline either first thing on a Monday morning, usually when people log into their systems after the weekend, or last thing on a Friday afternoon. That's usually when the organisation realises that it needs to notify its insurer. The benefit of having access to this hotline is it helps to fill in capabilities that an insured organisation might not have. So you may not have immediate access to these types of vendors, but your insurer will. And they'll have spent a lot of money developing relationships with well-vetted and trusted advisors for the benefit of their insureds. There's a cost benefit for both the insurer and the insured in using these panel vendors. So the insurers will have agreed discounted rates with their panel vendors that the insured organisation can also access. And the insurer will also have tried and tested systems and processes in place for particular types of incidents that help to ensure that the incident response is well managed and that it's sufficient and that losses are mitigated. Usually when you call a hotline, you'll speak directly with the incident response manager who'll take some initial details from you about the incident and then provide you and your insurer with some preliminary advice about forensic and legal assistance that you might require. Then they'll seek instructions from your insurer to incur those costs. Sometimes you might have an excess that applies to the initial cost. Say your excess is $5,000, then you'll need to pay the first $5,000 of that towards those costs, but your insurer will pay the rest, provided that coverage is extended. After notification to your insurer is made, they'll commence their coverage assessment, usually under the insuring clause for your first party cover, and then they'll give you a pretty quick indication as to whether they are covered. So you'll have some certainty about that pretty early on. Your forensic and legal investigation will then continue from there. Your legal investigation will focus on your privacy and your notification obligations arising from the incident. The legal team will require the forensic report so it understands what's happened and the extent to which any personal information has been affected. And notification and regulatory investigations will follow that. So you've heard me mention first-party losses a few times now, and you might be wondering what they are exactly. But first-party cover is what makes cyber policies kind of unique. So there are only a few other policies with similar first-party cover in place. And first-party losses can be significant. So one key cyber insurer estimates that over 90% of the losses claimed on its books relate to first-party losses. So first-party cover usually includes things like the cost of repairing and restoring systems or recreating data that's been damaged by the incident, the cost of undertaking forensic IT investigations to figure out what's happened, the mechanism of the attack, and the extent to which any personal information has been accessed or exfiltrated, the cost of obtaining legal advice from Privacy Council about your regulatory requirements, notification costs and credit monitoring services that you may wish to offer. Affected individuals will usually also be covered. Extortion costs, so paying ransoms to threat actors in order to return or decrypt your files. And finally, crisis communications and the cost of engaging a PR firm will also fall within your typical first-party cover. As to third-party cover, your usual cyber policy will include cover for claims by individuals affected by the breach, where the breach has resulted in the unauthorized access to personal information, or where the incident itself has resulted in damage to third-party systems. We're also starting to see some claims in negligence in contract for failing to properly protect personal information against cyber attacks, so that's something to watch out for. And of course, regulatory investigations by the OIIC and APRA and even ASIC, they'll likely be covered, as well as any fines that are imposed or sought by those regulators. And finally, liability claims arising from the insured's network security failures, as well as any legal defence costs incurred in defending these claims, would also likely fall within this category. So now to business interruption cover. This is arguably where you'll get the most value out of your policy. So business interruption losses usually start to escalate in circumstances where there's been a network or system shutdown or a denial of service attack, for example. But making a claim for cover under this provision is usually a pretty complex exercise, and some insurers even forget about pursuing claims of this type once they're back to business. So if you do look to make a claim for business interruption loss, you do need to look closely at your policy and how the insurer will calculate it and what information you may need to present to them to support your claim. So I've included in this slide some key definitions that you should be familiar with in your policy. The first is business income, which is a key definition for assessing loss of income. The insurer will usually look at things like your loss of profit during the period of shutdown, as well as things like your operating and payroll expenses. But check whether any additional expenses over and above your normal operating expenses are covered. So that might extend to things like adding more staff on to help you work through the incident. Sometimes that won't be covered as part of your standard business interruption cover, so be sure to check it. Sometimes it will also be necessary to complete a detailed proof of loss form for your insurer so that it understands how you calculated your estimated loss, and they'll also want you to provide any supporting documentation with it. And because it's such a complex exercise, you or your insurer might also need to appoint a forensic accountant to assist in assessing the claim and calculating the actual loss of revenue. The waiting period will be defined, and that's important in assessing business interruption loss because it reflects the number of hours or days that must pass after the incident before you can make a claim for business interruption loss. And that just reflects the expectation that some minor cyber events may only have a very limited effect on your business operations. The indemnity period is also important because it reflects the length of time for which cover is payable under a business interruption clause. So make sure that you're familiar with that clause as well. As to key exclusions, wordings do vary greatly, but there are some common exclusions that you should watch out for. So IP theft is starting to emerge as a consequence of cyber attacks, and cyber policies generally won't cover theft of IP or claims arising from any breach of intellectual property rights. So that includes patents and trade secrets. So if someone hacks in and steals trade secrets or confidential information, there won't be any cover for it. Exclusions due to a failure to maintain minimum or adequate security safeguards is something else to watch out for, though we're seeing this less and less now. But broadly, that exclusion says that no coverage will apply unless you're able to demonstrate that your patching system is appropriate or that you're maintaining your IT infrastructure in a way that the insurer finds acceptable. And it's a bit vague, to be honest, and I think that the policy would probably have little utility if every time an organisation forgot to patch something or deal with a known vulnerability that the policy excluded cover. I think in Australia, it seems that some insurers have moved away from this and they're, or at least they're interpreting it in favour of the insured organisation, but it's still popping up every now and again. Policies will usually also exclude the cost to improve internal technology systems, or what's known as betterment, and that includes any software or security upgrades after an incident. That said, some policies are starting to incorporate some level of cover for it, and that's to deal with the speed of advancements in technology and the difficulty with replacing old hardware and software with an equivalent. So there's also some acceptance that new options often facilitate more secure systems at a similar cost anyway. But I think this issue of betterment might come into sharper focus now that so many businesses have been forced to move their systems onto a mass remote working setup in a way that they never really contemplated. And the personal devices of many of these mass remote working setups have older hardware or systems in place. So there's probably a greater prospect of those older systems being caught up in a cyber incident and then cover being sought to repair or replace them. As to reputational harm, a company's share price or value can fall significantly after a data breach, and it may suffer significant reputational damage resulting in a loss of business. So these losses will typically be excluded by the policy, but remember that your costs of hiring a public relations expert to mitigate the damage to the company's reputation will likely still be included in your typical first-party cover. Cyber policies often also include exclusions for power and telecommunication outages. I think we might start to see some insureds claim under their cyber policies for employees who aren't able to connect to office systems, maybe due to failures on the part of their electricity or internet service providers for extended periods. But I think that infrastructure exclusions like this might work to exclude those types of claims. Now turning to some common tensions that we often see play out amongst insureds and their insurers. Some policy wordings require evidence of an actual breach before the insuring clause is triggered and don't extend to suspected data breaches. And this can cause some major implications for insureds who are urgently trying to access their first party cover under the policy, but don't have enough evidence to demonstrate that the insuring clause is triggered. We often see this in scenarios where there's been a mailbox compromise or a fraudulent payment transfer, when it's not immediately known whose systems, if any, were breached. And the root cause or the mechanism of the incident really needs to be understood to determine if the insuring clause is triggered. And that can obviously delay access to your first party cover. Incidents thought to arise from cyber terrorism or a state-based attack, they can give rise to some pretty obvious tensions. It's standard practice for most insurance policies to exclude liability arising from acts of war or terrorism. So when there is a declared war, it will be pretty obvious to both the insurer and the insured, but cyber warfare or terrorism is much harder to identify. And governments may in some cases allude to a cyber incident being linked to a foreign power, but it's often difficult to prove and it's usually denied by the accused state anyway. In the US, Zurich, which is a large insurer, has rejected a $100 million claim for damage caused by the NotPetya cyber attack in 2017, and they're citing the war exclusion on the basis that the losses that have been suffered were the result of hostile action taken by a foreign government because the attack was reportedly launched by the Russian military. As to physical damage, cyber policies generally exclude property damage and bodily injury, but hackers are increasingly gaining access to control systems that would enable them to take control of physical assets, which is increasing the potential to cause property damage or injury. Last year, I assisted an aged care facility that was affected by a ransomware attack and was unable to access its electronic medical records. Fortunately, in that case, the facility recovered access very quickly. They paid the ransom, but you can see how things could turn quite quickly, and there might be some real non-monetary consequences as a result of incidents like that. Now to the issue of consent. So if you seek to appoint your own vendors prior to notifying your insurer under a policy and you don't obtain consent, you may incur costs that are in excess of the insurer's approved scope of works or at rates that are higher than the insurer's panel rates. And that could lead the insurer to argue that it suffered additional costs as a result of your failure to comply with the policy conditions. So it's something to look out for. Failure to obtain consent could mean that the insurer will only pay those costs that it would have incurred had you engaged their panel vendors. So make sure you check your policy before you incur any expenses. Some insurers may require you to obtain their consent before you do that. So with all that in mind, what should you expect when you make a claim under a policy? So I think this slide gives you a general idea about how things might play out. The incident will occur and there'll be a flurry of activity. You'll notify the incident to your insurer, vendors will be appointed to assist you, and hopefully you'll receive a fast determination on coverage for your first party losses. So your data restoration, maybe your forensic and legal costs as well. Things will probably return to normal shortly after that and when your systems are back up and running or when the incident's contained, but your forensic and legal investigation might continue for a little while, and you may also need to notify regulators and any affected individuals if the incident gives rise to an eligible data breach. Once notification is complete, the regulator may want to commence an investigation, or it may have some further questions about the incident, but it's probably around that time or shortly after your notification to the regulator and any individuals that you'll first have an opportunity to assess the impact on your business, and you may look to pursue a business interruption claim under your policy at that point in time. Third-party claims are usually the last component, and they may not be made against you for months or even years after the incident. Because different insuring clauses under your policy will apply at various times, you'll need to make sure that your insurer remains updated and that you put them on notice of any complaints or likely additional costs as the matter develops. The earlier that you inform them about those things, the earlier anything contentious can be ironed out, and you're more likely to avoid any surprises on cover. The insurer will also want to be involved in some of the key strategic decisions. So things like which vendors you engage, how you manage the notification process to the regulator and any affected individuals, what type of call centre you might have in place to deal with those types of issues. They'll also want some insight about the responses that you intend to provide to regulators and how you'll manage third-party complaints. So be sure to keep them informed as things progress. So how do things go wrong? Well, one big one is when there's delayed notification to insurers. So sometimes insureds will want to keep things in-house before they notify their insurer, and that can delay some of the key issues, and it might not end well for you. So remember that prompt notification to your insurer is usually a condition of coverage under your policy. And it's particularly important for cyber claims because your first party losses can escalate quite quickly after an incident. And if they're incurred without informing your insurer, then you can potentially compromise your coverage position for those costs. So some typical scenarios in which you might need to notify include when an employee loses their laptop, or you discover you've suffered a business email compromise event, or a ransomware event. So also remember that one of the key benefits of having a cyber policy is that you have immediate access to the panel vendors that have been vetted by the insurer, that have insurer rates attached to them. So early notification to insurers is also critical to make sure that you actually get the benefit of the policy and access to those vendors. Early notification to regulators also occurs. So I've often seen some organisations notify the regulator prior to notifying their insurer and prior to completing an adequate forensic investigation, and they don't fully understand whether the incident has met the threshold test for notifying an eligible data breach. I had one matter where the insured notified the Privacy Commissioner before informing its insurer, and we were appointed subsequently after that. At that point, we engaged a forensic IT vendor to investigate what had happened, and he discovered that there had been suspicious activity, but critically, no personal information had been affected, and the threat actors were only using the insured's systems to mine cryptocurrency. So in those circumstances, notification to the regulator and affected individuals wasn't actually required. There's definitely confusion about coverage, and I think this point really ties into the misconceptions around cyber insurance that I mentioned earlier. Sometimes insurers will call the hotline in the middle of the incident, and they'll have some expectations about what is covered under their policy that doesn't come to fruition. And I can tell you, I do not enjoy communicating declenitures to insureds in the middle of a crisis. So to avoid any disappointment, I strongly encourage you to work closely with your broker so you understand exactly what it is you're covered for when the inevitable happens. Underinsurance is another big one. So sometimes you'll have certain sublimits in your policy, meaning that the total amounts that are payable for coverage under different insuring clauses, they'll be capped at monetary amounts. So for example, a cyber policy might contain an extension or an add-on for fraudulent funds transfers or social engineering, and it might have a limit of say $20,000. Or your policy may not include cover for things like ransom demands or losses arising from an incident affecting a third-party service provider. So make sure you consider these types of risks before you purchase a cyber policy so that there aren't any surprises when you first go to make a claim. And finally, we often see claim scenarios in which the insurer's IT team has inadvertently wiped all the forensic logs or failed to retain an image of affected servers prior to notifying their insurer or engaging a forensic team to investigate what's happened. This often occurs in ransomware events where the insured is really eager to get things back up and running, but it makes it incredibly difficult for the forensic vendor to properly form a view about whether any personal information has been affected as a result of the incident because there's an absence of any forensic artifacts or logs available. So make sure you take steps to preserve the types of evidence that a forensic IT expert might need after the incident so that you can investigate the path of the threat actors through your systems. So hopefully you don't have a headache yet, but as to any treatment for avoiding these types of insurance headaches, there are a few. So just to end, I'll work through each of these just very quickly. But of course, test your incident response plan. You'll all know that preparing for a cyber incident starts well before the incident occurs. Incident response planning is super important. You need to have it practiced so people within your organization know exactly what to do. Your incident response plan should identify your key team members and how decisions will be made and any relevant insurance provisions or contacts. And an effective response will involve all aspects of your organization. So the CEO, the board, HR, media relations, and your IT team, you need to make sure they're also engaged when you're conducting any scenario testing. So regular testing of those plans will help to make sure that everyone that's involved knows what to do and who to turn to when an incident happens. Conduct data mapping. So if you perform this, you'll be able to make a prompt and thorough assessment about the extent of the breach if one occurs. So organizations that understand their data holdings, they're best placed to assess whether a breach might be notifiable or not. Look at what data you hold, who holds onto it on your behalf, whether you hold any sensitive information, and know where it's stored. So knowing these things will also help you in the underwriting process, and it will help to demonstrate to insurers that you are on top of your security controls and information governance, and that you understand your cyber risks. Request onboarding with your insurer. So some insurers will do this as a matter of course, but if they don't, request an onboarding process so that you can sit down with them and make sure you understand how their incident response process will work and how your policy will operate when there is an incident. You want to leave that meeting with everyone knowing who they need to turn to, have key people in the room, and ask that the panel vendors also come in and meet with you. Engage and collaborate. So after the onboarding process, you'll probably have very few touch points with your insurer. So stay engaged with them and take it seriously. Don't just go through the motions and just purchase the policy. Build a relationship with your insurer. Get a good broker to help you to navigate through these things with your insurer. Meet with your broker, test the hotline, and don't try to figure that out when there is an incident. And finally, if you have a breach, then notify your insurer early. Notify early and maintain ongoing communication with your insurer, and notify them as soon as you become aware of a breach, even if you're not sure that you'll suffer any loss. Notifying insurers of circumstances that might give rise to a claim at a later point in time can be important, and it's important because you need to protect your rights in the event that a claim does actually arise. And sometimes things that appear pretty low-key at first can have pretty severe or unpredictable outcomes, so keep that in mind.